Hello friends, today I will be taking you through one of the very important standards in auditing, which is standard 200, SA200, which is talking about the overall objectives of the independent auditor and conduct of the audit in accordance with the standards of auditing. This is a very base standard and it is called as the mother of all the standards in auditing because this is the one which is applicable while carrying out the audit of any entity, listed, unlisted, public, private, partnership, corporate, any entity. So let us go through in detail and understand what this standard is talking about. The purpose of the entire standard is to enhance the degree of the confidence of the intended users of the financial statements, which means that they rely upon the work done by the auditor. The auditor assures of the correctness and the true and fair view of the financial statements, and he also provides an opinion on the true and fair view of the financial statements. However, as per the auditing standards and some of the other regulatory requirements, the auditor is required to go beyond the true and fair view. So for example, in the case of corporates, the auditor is required to report under CARO, which is called the Company's Auditor's Report Order, whereby there is an annexure to the auditor's report in terms of some of the specific aspects where the auditor is required to give an opinion. In addition to that, again, for certain companies, the auditors are required to report on the internal financial controls over financial reporting. So this is basically the standard which talks about generally the objectives of an independent auditor. The overall objective of an independent auditor is to obtain reasonable assurance, and I repeat the word, reasonable assurance, as to whether the financial statements are free from material misstatement and is being prepared using the applicable financial reporting framework. Now, if you analyze this particular statement, it says very clearly that the auditor is required to provide reasonable assurance, which is a high level of assurance, However, it can never be an absolute assurance because the auditor will carry out the audit in line with certain requirements and basis the test checks that he will carry out. So he provides a reasonable assurance that the financial statements are free from material misstatements and that they have been prepared in accordance with the financial reporting framework. So over here, the financial reporting framework could be Indian GAAP, could be Ind AS, or it could be any other GAAP, international GAAP as well. Second most important thing is that the auditor reports on the financial statements and communicates all the auditor's findings as required under the standard to the management, to the board, and to those charged with governance. So these are the overall objectives of the auditor as laid out under this particular standard. Now let's go into the responsibilities of the management. Whenever we talk about the audit, we talk about the auditors. But when the auditors start auditing the financial statements or they start the audit, one should also understand what are the responsibilities of the management. So the management is required to provide enough and adequate information to the auditor for the auditor to carry out his duties diligently, and therefore they are responsible for the preparation of the financial statements within the applicable reporting framework, which means that it could be Indian GAAP, it could be IFRS, it could be Ind AS, it could be anything, and that such financial statements are free from material misstatement, which means that there can be chota-mota errors, but there cannot be any kind of a material amount which should be misleading within the financial statements. The management should be required to provide the auditor all this information. So which is this information? It is about all information that is relevant to the preparation of the financial statements, any additional information that the auditor may want to carry out certain inquiries and certain procedures which he believes is important to sign off on the true and fair view, and therefore the management should be giving unrestricted access to the independent auditor. In the event that the management does not provide adequate information for whatever reasons, then this is called the limitation on the scope of work of the auditor, and that should be clearly brought out by the auditor in the audit report. Let us now talk about the requirements of the independent auditor. Some of these are related to the ethical requirements relating to the audit of financial statements. So while carrying out the audit, the auditor should apply the following principles of professional ethics to carry out the audit of financial statements. The most important being the integrity of the auditor. The auditor should be completely, absolutely having the highest level of integrity while carrying out the audit. He should not have any other thoughts in terms of any profit or any kind of unjust enrichment while carrying out the audit. Objectivity. The objectivity and independence of the auditor is equally very, very important. The auditor needs to be independent completely, and at the same time his objective is to provide a true and fair view on the financial statements of the company. The third one being the professional competence, which means that the auditor should carry out his duties absolutely in a professional manner, applying the highest level of ethics, integrity, and the levels of competence, which means that he should be in a position whereby he understands what he is doing and should be able to provide reasonable assurance in terms of the true and fair view of the financial statements. Confidentiality, which means that nothing can be shared beyond what can be shared. So it's important that information that he has received during the course of the audit be retained in terms of its confidentiality. And as far as his professional behavior is concerned, he needs to be very upright. He needs to ensure that professional skepticism is applied of the highest order, and at the same time, everything that is required to be done as part of the audit procedures, he very professionally carries out such work as well. Let's talk a little bit about professional skepticism. If I have to understand this particular jargon of professional skepticism in a very simple manner, it means that how will an auditor evaluate using rationale, using his knowledge in terms of the decision that he needs to arrive so that he provides a true and fair view, or wherever he believes that it does not provide a true and fair view, then he will accordingly provide a remark or what we call as a modification or a qualification in the audit report. Normally, professional skepticism includes being alerted in terms of some of the important things. One could be the fact that the audit evidence contradicts other audit evidence obtained, which means that in the event that the auditor has got some particular evidence and that evidence is the one which is contradicting with any other evidence, then he has to use his judgment. And normally that judgment will depend upon to what extent the auditor will evaluate which one to rely upon and which one not to rely upon. For example, if at all there is an evidence which is a third-party confirmation or which is an external evidence, then definitely the auditor would place more reliance on the external evidence. Second thing, information that brings into question the reliability of documents and responses to the inquiries to be used as audit evidence. In the event that the audit evidence can be relied upon, fine. In the event that it cannot be relied upon, what could be the alternate channels? What could be the alternate evidence? And to what extent he can derive comfort from that alternate evidence is something that professional skepticism will enable him to come to that conclusion. He also needs to be completely aware of the fact that there could be conditions which could be susceptible to fraud as far as the management is concerned, as far as the financial statements are concerned, and therefore he needs to carry out a fraud risk assessment. And having carried out the fraud risk assessment, he needs to determine to what extent there can be conditions which are susceptible to fraud, and accordingly he needs to devise certain audit procedures to make sure that the financial statements are drawn under the applicable reporting framework and that they are free from any material misstatement, including errors and frauds. And the fourth one, which is important from a professional skepticism perspective, is the circumstances that suggest the need for audit procedures in addition to those required by the standards. So the standards will lay out certain audit procedures. What is more important over here is that in the event that the auditor believes that he needs to deep dive, he needs to run an extra mile, he needs to carry out some more procedures, then he will decide based upon his understanding, thinking, and the kind of judgment that he would come up to carry out some more work. For example, in the event that I would want to verify as to whether a particular debtor or a creditor is in existence, then I may go to the extent of even finding out from Google or from finding out from the internet as to whether this party is in existence, and may even depute one of my representative to see whether this particular office is actually in existence or not. These are the part of the auditing standards, but it does not require that you need to carry out to that extent. But wherever the auditor believes that he needs to deep dive into that extent, then he has all the authority and the right to do so as well. Matter of professional judgment. Auditing is not easy. It is evaluation of many things. It could be an evaluation of judgments, it could be evaluation of certain standards, it could be evaluation of disclosures, and therefore the auditor should exercise appropriate judgment while carrying out the audit. And that judgment can be in relation to materiality and the audit risk. When we talk about materiality, it could be the materiality during the planning, it could be the materiality during the execution, it could be the materiality from a reporting perspective. And the audit risk is something which every auditor lives with. To what extent the audit risk is embedded in the financial statements, whether those are absolutely mitigated or not, is again a matter of professional judgment. Second most important thing from a professional judgment perspective is the nature, timing, and the extent of the audit procedures in order to meet the requirements of the standards. So an auditor obtains an understanding about the internal control, about the business of the organization, and accordingly he carries out an evaluation of the internal controls. Having seen the design of controls and having tested the operating effectiveness of controls, the auditor will then decide about what would be the extent of procedures, what would be the timing of procedures, and what should be the nature of procedures. And accordingly, he will do the work accordingly. The third thing would be in relation to evaluating whether sufficient and appropriate audit evidence has been obtained and whether more needs to be done in order to attain the objective of the standard, which means that the auditor is required to evaluate what evidence does he have. Has he taken a right decision in terms of saying, yes, this is the right thing or not the right thing? And whether he needs more information is again a matter of judgment. And in case if at all he needs more information, then he can seek that externally through his own sources, or he can request the management to provide such information. Fourth thing, and we all know about this because this is coming mostly in every standard, that the evaluation of management judgments in applying the entity's applicable financial reporting framework. Today, judgments are there in most of the accounting policies. For example, which method of depreciation to be followed? What should be the method of stock valuation? What should be the method of stock options to be evaluated or to be valued at the year end? And therefore, a lot of these estimates, which are the prerogative of the management, need to be evaluated by the auditor. In the event that the auditor is not competent to evaluate such judgments, then he should seek external help. He should seek the support of an expert and accordingly get the comfort on the estimates made by the management. And finally, the drawing of conclusions. So having come across certain matters, having evaluated those matters, the auditor needs to conclude that whether the financial statements then are true and fair. So to what extent he has disposed of the observations that have arisen during the course of the audit. If at all there is any kind of a misstatement, or if at all there are any misstatements, then he needs to evaluate the aggregate impact of such misstatements. It could be both running into positive or negative. When you aggregate it, you will get that particular amount. In the event that you believe that this amount is below the materiality threshold, which can impact the financial statements materially, then in that particular case, the auditor can take a call and say that fine, there is no need to make any adjustments, and therefore they are called as unrecorded adjustments. In the event that the net impact of such unadjusted errors or omissions is beyond the materiality threshold, then the auditor will have to make sure that these adjustments are given effect to in the financial statements, so then that the financial statements give a true and fair view of the state of affairs and of the results of operations of the organization. Now let's talk a little bit about sufficient and appropriate audit evidence and the audit risks. So when we actually audit as an auditor, we need to make sure that the evidence has to be not only sufficient, but it has to be appropriate as well. And therefore, we talk about the fact that sufficiency is the measure of the quantity of audit evidence, and appropriateness is the measure of the quality of evidence, which means that you need adequate information, but at the same time, you need qualitative information as well. And therefore, there has to be a good balance of sufficiency and appropriateness of audit evidence to enable the auditor to conclude whether the financial statements provide a true and fair view. Let's talk about the audit risk. Now, what is the audit risk? Risks which arise during the course of the audit are the function of the risk of material misstatement and the detection risk. So it's a combination of both. There can be a risk that there could be some errors and omissions which have gone into the financial statements or which could have been missed from the financial statements. And there can be also a risk that such errors or omissions may not be detected. And therefore, we call it as a function of material misstatement and the detection risk. Some of the inherent limitations of the audit, some of these relate to the nature of financial reporting. For example, there could be lack of qualitative aspects. It depends upon the various gaps. It depends upon the various reporting framework. And therefore, accordingly, you need to take a professional judgment as to whether these financial statements under different reporting frameworks are being prepared in light with such reporting frameworks, both in terms of presentation and disclosure and in terms of recognition and measurement. Nature of the audit procedures. Some of the audit procedures could be comfortably carried out, some of them could not be comfortably carried out on account of want of audit evidence, and therefore the auditor needs to deep dive more where he does not have comfort to make sure that he gets into alternate modes of evidence to derive the necessary comfort. The need of conducting an audit within a reasonable period of time and at a reasonable cost. Now today, this is one of the most important challenges in the audit. The timelines are very, very stringent. The timelines are very, very aggressive. And unless and until the management is not in a position to provide adequate financial information and other information to the auditors, including the financial statements, the auditor may not be able to do a quality audit. Secondly, an audit should not be perceived only to be an activity where the auditor would just stamp and give the financial statements. It has a cost related to it, because today you need to invest into people, you need to invest into training, you need to invest into tools, you need to invest into technology, and you need to make sure that there is a right team with the sectorial experience to carry out the audit. Audits are very, very expensive, and therefore the fees need to be commensurate in line with the efforts and the kind of team that you have built up and the cost of such team as well. Finally, of course, the nature of audit evidence. Audit evidence can be loose, audit evidence can be substandard, audit evidence can be great. And therefore, it is one of the limitations while carrying out the audit in terms of the adequacy of the evidence and the appropriateness of the evidence as well. Finally, what happens when you fail to achieve the objective of this particular standard? In case you believe that there is a scope limitation to carry out the audit, in case you believe that there is not of material information available to you to conduct the audit, in case you believe that the audit evidence is neither appropriate nor adequate and vice versa, or a combination of both, and if you believe that the financial statements may not give a true and fair view of the state of affairs of the company as of a given date and of the results of operations for the year or for the period, then the auditor can decide in terms of whether he needs to give a modified opinion. A modified opinion can be a disclaimer of opinion, can be a qualified opinion, it can be an adverse opinion. And in the event the auditor believes that it can be a disclaimer of opinion or an adverse opinion, the auditor first of all will have to contemplate as to whether he has to resign from the audit. And in the event that he cannot resign from the audit for whatever circumstances, then he needs to communicate that to those charged with governance. And whichever report he believes is appropriate under the circumstances, he will have to issue that particular report. So this is in terms of the objectives of an audit and the information that is being provided by this particular mother standard called SA200. Friends, this is the standard which is basically the fundamental and it is the edifice of any audit of any organization. Thank you very much.